Hello and welcome to Policy Watch, your weekly date with everything that's making headlines in the world of business and economics. I'm Surabhi Upadhyay. As election frenzy enters its last stage and markets surge in optimism, we actually turn away from the noise this week to look at three different stories. A big arrest in a big scam, an important international move to curb black money, and some encouraging economic forecasts for India. Joining me in the studios this week is Jagannadham Thunuguntla of SMC Global. Great to have you, Jagannadham, in the studios. So we have plenty to talk about. I'm going to start with this first story, which is all about a very, very high-profile arrest. And it involves a big scam, 5,600 crore rupees of the National Spot Exchange scam. Jignesh Shah, Chairman and Group Chief Executive of Financial Technologies, a man synonymous with commodity trading in this country, now finds himself behind bars. Shah's arrest is the 10th one in the commodities trading scam that was unearthed in July last year. NSCL is a spot exchange, meaning it couldn't offer futures contracts, but it was allegedly doing so. Now, as investigations dragged on, the possibility of fraud and promoter involvement also emerged. On the 14th of August last year, NSCL had proposed a payout plan, but it has been unable to stick to the schedule and has not made a single successful payout ever since. Well, it seems to be an all-time low for an aggressive entrepreneur who set out to build a global business of running trading exchanges. Meanwhile, the Forward Markets Commission, or the FMC, on Tuesday came out with a new set of guidelines for ownership of commodity exchanges. According to these new rules, commodity exchanges, stock exchanges, depositories, banks, insurers and public finance institutions will be allowed to hold up to 15% stake in commodity bourses. Individuals, however, will not be able to hold more than 5% in a commodity exchange. Public holding overall will have to be at least 51% of total shares. Foreign holding, that's FII holding, has been capped at 23%. FDI remains capped at 26%. So these are the basic details with which we are working right now. And I think, Jagannathan, even as we speak, Mr. Anjani Sinha, the former CEO of this troubled exchange, NSCL, I think he was granted bail, I believe, yesterday. But it's astonishing. The whole story, the rise of the FTIL empire, the rise of Mr. Jignesh Shah, and all that's been happening with NSCL. What's going on in the commodities world?
Before going into the bad side of it, I think we have to appreciate the fact that the technology infrastructure or the whole ecosystem that they brought into the equation definitely elevated the way exchanges are seen it, and the technology comfort. Because from the technology infrastructure point of view, probably India is far ahead than even the developed markets, because we are at least on par with any developed market in the world. And from the start with the NSE exchange, so many better things have happened. But I think the growth the growth also has been very rapid. But many of the times when the growth is going on, all the ecosystem and corporate governance around you has to be maintained very, very well. Otherwise, there is always a chance of loopholes and mistakes to happen. And who is at wrong and who is the guilty, all these things will happen, because considering that investigation is going on. But at the current moment, it has left a lot of bad taste in the mouth of investors.
So let me ask you the basics first. Since this scam came to light, and I remember all the big headlines and investors crying foul, what has happened to volumes overall in the commodities market?
Commodity volumes, unfortunately, have went down. So in the sense,
do you think it's a fallout of the scam, or is it more to do with the market itself and other factors?
No, I think both, because when the equity volumes were subdued for last 6 years, when the equity markets not done well, commodity volumes actually picked up during that time, 2008 to 2013. But when the scam has picked up, by that time it's a coincidence that equity market started doing well. So there is a sudden shift away from commodities into the equities, understandably so. One is commodities, definitely after the scam came out, the volumes have went down. Naturally, confidence level will disappear, and people will keep doubting each and everything. Skepticism will be there. But it's an irony that a man who has created such a big ecosystem of elevating the volumes has suddenly become the reason for the dip of the volumes. I think it may take considerable amount of effort from everybody in the ecosystem to re-elevate the confidence levels and the credibility, and not just in India, globally, because you have to appreciate that FTL as a concept or a commodity exchange in the whole, it's not just India phenomena. They operate this in many other places as well. That means even global players must be watching all this very carefully.
How far within the FTL empire, what all now remains at least relatively insulated? Or has it been that the scam has pretty much tainted everything? And for instance, MCX and the way people are perceiving this company as opposed to some of the other exchanges?
We have to appreciate one fact that any company should be analyzed at two fronts. One is business, other is management. If we talk about FTI's business, its technology is one of the best in the world, and if not the best, and excellently run, top class system, state-of-the-art facilities. Nothing to take away from that fact. Second is the management. That is where the whole question mark is. Simply because management is not up to the mark, that doesn't take away the goodness of technology. I strongly feel that many IT companies and many business empires must be eagerly awaiting to get the ownership of the business side of the equation, because it's the same thing as happened with Satyam. The moment Mahindra and Mahindra stepped into the whole equation, suddenly the whole profile has changed. I think the same is, we're talking about one of the best technologies in the world. It's very difficult. We can't even think of a competitor, meaning that how many businesses Surabhi in India, any business you can think of, where is the business where there is no competitor? Very, very few in India. So this is one of the rare precious.
Which is why MCX got its lofty valuations when it listed as well, when they did their IPO. But let me ask you this, that today when clients ask you for advice in commodity trading, do you tell them to back off or do you tell them to go in? What kind of contracts? Because NSCL, apparently this whole furor deals with the sort of contracts they were dealing with. I remember, of course, doing interviews at the time this exchange was being set up, and the talk was that it's going to be a genuine price discovery for farmers. I don't think that was really what was happening at the exchange, right?
One thing is, as far as NSCL is concerned, there is a difference between MCX and NSCL. MCX directly comes under MCMC. NSCL, now everybody got to know now it doesn't come under anyone. That's a strange fact, but it doesn't come under anyone. So to that extent, there is a huge difference. So if somebody is coming and asking us, we don't discourage them from commodity trading by no means, because an Indian system has weathered through many crises in the past, be it 1991 crisis, let's say 2000 crisis, many crises, many bubbles. Indian banking system has weathered through, Indian stock exchange system and commodity system also weathered through. So whatever the crisis this time is spot exchange, unfortunately, which doesn't come under anyone. It's a big loophole that was there in the ecosystem that got exposed now. Hopefully that matter will settle. The worrisome part is that many, even the retailers and HNIs, and put their hard-earned money into this whole equation. That means they will never come back into the markets for sure, because they must be losing significant amount of their net worth through this.
But were they entering these quote-unquote illegal contracts at NSCL knowingly? In that case, you can't purely blame perhaps the exchange.
True. I think here the worrisome part is many people are putting their hard-earned money without knowing what they're doing. I mean, because that's what every time in financial markets, whenever the crisis happens, it's because people haven't done their homework or their.
So someone is suggesting, oh, here's a great product, you will get this kind of return, go and invest.
Because what happens is that, especially if such product comes from a group like FTI, I mean, naturally nobody will question back, because
you tend to trust
because such a big ecosystem, why will they fumble on my small 20 lakh rupees? Because that's the typical HNI mentality. But the question comes that because every time the trust gets broken, where there is trust, because where there is no trust, the question of breaking doesn't arise. So that's
so lots of rules have come out in the last 1 week. The FMC came out with guidelines, as we just mentioned, on ownership, and there are so many other details they've given out. Fit and proper criteria. Anybody who holds more than 2% needs to be fit and proper to run an exchange. To what extent will this help? What happens to FTIL, to Mr. Shah, and to the
this is a beginning of repair work, because repair work of the whole ecosystem. I'm sure now the scrutiny will increase on the whole regulations, and they will try to plug as many loopholes as possible. But frankly speaking, it's too late in the day, because whatever damage that has to happen, it has caused. I think the whole thing will change if any of the corporate house can able to put their bold face, and then can able to come and take over the ownership, so that at least if that equation can be solved, because the credibility loss that happened through loss of money can only be regained only by repaying the money, because you can't get the credibility back through any other mode. So to that extent, I think now how the Indian corporate system will trigger, as Mahindra and Mahindra did in the case of Satyam. Will there anybody is there to put that kind of front foot? Or because Finance Minister was more than clear. He said that we have nothing to do, because he said that why will Finance Minister come into the picture in the whole thing?
They don't have a business to run any exchange.
And now considering new government is around the corner, so how will they? So in the next 1 month, 2 months, 3 months, I think there will be many other things will come besides the new regulations. I think the stand of the new government will also be critical
on this trading. All right, we will take a very quick break. On that note, on the other side, it's not just regulators who are trying to set things right. Almost 46, 47 countries are coming together to curb black money. Will they be successful? After the break. Welcome back here with Policy Watch. Now, India moved a step closer to gaining access to bank account information of its citizens in offshore banks after a host of countries, including Switzerland and Singapore, committed to share all financial information with other governments. Ending the practice of banking secrecy, eventually all financial information will be shared between governments, which will include, of course, taxpayers' bank balance, dividends, interest income, and sale proceeds used to calculate capital gains tax. This under the pledge signed by a total of 47 countries. Now, France last year provided a list of about 700 Indian citizens who allegedly hold HSBC bank accounts in Geneva. Switzerland characterizes this information as stolen data and says it's not required to share this information with India under Section 26 of the Double Taxation Avoidance Convention between the two countries. The OECD will deliver a detailed commentary on the new standard as well as technical solutions on implementing this information exchange during a G20 finance ministers meeting, which will take place later this year in September. Ongoing effort, Jagannadham, we know, and black money is such a hot potato politically as well, but do you think we'll ever move on it?
I think, again, as we just discussed, new government is around the corner. I think many things, how they want to approach the whole thing, because considering they will have 5 years of time, because it's not a 1 day or a 1 week phenomena, it's a long-term phenomena. And also, murmurs are coming that the new government, after they coming, they will announce, even for Indians, they will announce a policy where people can come and open the unaccounted money they can publish, as Chidambaram has done about 15 years back. That means, because the basic idea is
like an amnesty
amnesty, because the basic idea is to bring the black money into the whole system, because otherwise what happens is that black money will remain unaccounted permanently without helping the society or the economy. I think these countries, this may be a good move in terms of all the countries at least coming for transparency, but frankly these are easier said than done. I think the transaction nexus and web is much more complicated.
I guess this problem operates at two levels. One is this international understanding of sharing information. That's the first assumption. Even if we assume that, okay, that gets put in place by September, October this year, we come to the second level, the willingness of the Indian government to really go after these bank accounts. Do you think we'll succeed at either level?
That's why I was mentioning that new government, how they want to approach the whole thing will be critical, because whatever the agreements that happened are a good step, at least at the current juncture. But easier said than done. The nexus is much more complicated, considering that there must be many tax havens. Switzerland is only one equation. Otherwise, there are many ways, because it's Mauritius, as we've seen with last time when so much hue and cry happened with the retrospective taxation, and so much of hue and cry happened.
We recalled our own law. I mean, we didn't dig our heels in on that matter.
Absolutely, because and one more thing is, whatever the sharing that happens, question is that whether it on a retrospective basis or a prospective basis, because that means only the new information will be shared or the old information shared.
Which doesn't then help India's case. If you're only going to reveal account details after this agreement is put in place, and there's no track record.
If it's a old information, then again the same old question of retrospective element will come. What's the difference between what happened with Vodafone case or with this one is the one and the same thing. So all in all, and moreover, when global companies, when they came into India, they will be creating their corporate structures, keeping these taxation elements into tax events into account, and accordingly they will structure. Now, if all this information comes out, then all their original structures will go for a toss. Meaning thereby, it's not a just a signing of agreement will bring out so much of data. I think many complex questions need to be answered.
So here's a trick question. Do you think any of the political parties or any of the political groups will actually muster up the strength and show the will to do this? Or is it only manifesto talk and election rally talk?
I think before 16, nobody would like to answer that. I think everybody would like to play their cards only after. And that even we have to remember that at least 2-3 months will take for budget after that. And then everybody would like to look at the majorities and parties and so many complex things. I think it's very easier said than done.
Does it have, or could it have any implication for flows into the stock market or just sentiment in the market? Or do you think it won't
at
matter?
The current juncture, it's market is just flying away. I think market is not in a mood to listen any of this. I think market is just because we have to see it in the context. After 6 years of lull, finally the market is in that breakout mode. I think it is not listening absolutely anyone and anything. So in that sense, I think market will take this in stride. But when the nervousness again will come back, then all this will become the headlines, because then to pull the market down, I think even a small, even one account information leakage or announcement, we can cause the market significantly lower.
A little jittery.
Yeah. So I think we are at that precarious point in terms of capital markets. Is that market is at this moment is going on steroids, is not in a mood to listen to anyone. But how long this rally will continue, I think can be answered on 16th.
Does anybody know what's going to happen on the 16th in the market?
I think largely what market is of the opinion is that anything about 220 probably market will take in easier spirit. But anything
220, the NDA combined.
NDA
the inflection figure seems to be 220.
If anything below 220, I think it should be a serious sell-off. I think considering that South that Chandrababu Naidu had to tie up and all these things will do matter because anything below 220, frankly around the 200, it's one and the same thing whichever government comes. Because when you are not in a position to take decisions, how does it matter who you are? Because it's all about you can't take a decision, so it's one and the same thing whoever you are.
Oh, it's a different matter. People are also somehow getting together numbers of 300 thereabouts, but then that's the stock market. We'll take a quick break on that note. On the other side, no speculation, some data and some forecasts that are coming in for India from international shores. Back in a moment. You're with Policy Watch. Now, India could be in for a gradual economic recovery, but rising bad loans are a big concern, says the Organization for Economic Cooperation and Development, or the OECD. In its outlook release this week, the Paris-based think tank said a rebound in capital investments and a pickup in private consumption will put the economy back on track to notch up a growth rate of about 4.9% in this calendar year. Now, this will be a better number than last year's 4.5% GDP growth. Growth is supposed to accelerate to 5.9% in 2015. According to the OECD estimates. The optimism is based on expectations that industrial investment will rebound after elections and that large investment projects that have already been approved by the Cabinet Committee on Investment will also start rolling out, thereby helping boost output. The report, however, highlights the importance of labor and taxation reforms to improve business sentiment. Interestingly, OECD seems to be in support of RBI's recent idea of setting an inflation target for the country. The report says, and I quote, "The proposed inflation targeting framework will help anchor price expectations and improve business sentiment and consumer confidence," unquote. OECD has, however, flagged off rising bad loans as a major risk to the country's economic recovery, saying that NPA problems could derail the investment rebound. Okay, so this is a broad sense of what this report has said. Jagannadham, let's talk numbers first. The numbers I don't think surprise because most estimates for this year and next year are somewhere between 5 and 6%, right?
Absolutely. I think even the CRISIL that came out with about 6.5% as for next 5 years, not just for 1 year. So I think they said that even to achieve that 6.5%, new government has to be very decisive, and then they have to especially trigger the infrastructure demand, because infrastructure is the single point that can make a huge difference in the whole equation. And the problem is that currently that investment cycle is so broken. I think no new investments happening, no productivity is very, very low. So for a new government, they have to trigger this confidence level so that people can able to put new money to increase the capacities, so that productivity can increase, and then can leading into the GDP growth at least towards 6.5%. Otherwise, we have to appreciate one fact that we are a country of 120 crore population. The biggest worry is the unemployment, because the aspirations of the people are at such high levels. Any unemployment or underemployment, I mean either ways, I think will create so much of dissatisfaction, can lead to so much of social unrest. Sure. I think for new government, whatever said and done, as at least the prime ministerial candidates are taking a stand of growth as their paramount topic, they have to live to their words, because otherwise we are at a very critical juncture.
To what extent will the decisions of the Cabinet Committee on Investment, as the report also acknowledges that it's not as if the UPA government didn't do in the final year, they were trying to do some damage control. To what extent can those projects help stir things? There's some estimate, I think, that it could contribute some 6% of GDP, etc. What do you think?
I think about 15 days back, the announcement of Supreme Court allowing the mining in Goa, I think that itself can make a huge difference, because unfortunately what happened was that India has surplus of coal and iron ore, but it can't mine. Because of restrictions. That's a little weird, because we are importing, especially when our rupee is so weak, because we have to preserve each dollar possible, and then we are lavishly using our dollars for importing the same old coal and iron ore, which we ourselves surplusly having, but we can't mine because of the Supreme Court regulations. But with this new Supreme Court announcement, judgment, I think the benefit is that probably that will trigger the mining in Goa, so probably that will reduce the impact on the imports of these items, so that the rupee can strengthen. I think even if we can able to solve these complex issues, I think because corporates are always hungry for expansion. We have to remember that they are always hungry for capacity building. Just that kind of environment, that kind of situation has to be created. I think hopefully the new government can able to do it.
I guess that's why this election has become the mother of all elections. From an economic standpoint, I don't remember the last time a general election was so critical for the economy. But I want to move to the other aspect of this report, what the report has to say about the RBI and its policies. First of all, support coming in for inflation targeting. Do you think India is ready for something like this? Because the target the RBI's report mentioned is just 4%. We are at double of that right now.
I think all this topic again came into limelight in the Ajit Patel committee report when they talked about change of the anchor point. I think India is a country where I think the new stand that they are taking is much better because country we have huge middle class and lower middle class. But the number I think is
like a dream, 4% inflation.
virtually impossible to reach there. I think even 6%, I think 5.5%, I think RBI will easily take it. I think they will understand the ground realities. That's the way we have to live. And considering that with the rupee weakness, we are such a huge oil importer, we have to live with this high inflation. I think we will see probably close to that 4% inflation only in one scenario. If rupee goes back to that 40 or the levels that we are seeing, which I think is such a far away target.
And we strike oil, and we start using our own coal and iron ore.
Absolutely.
As you
so coal, iron we import, and then oil any which way we have to import because we don't have any which way capacity. So we are in that sense. I think if we can able to address these basic issues, I think animal spirits can come back because.
Very serious note here, the rise of bad loans. Everybody is talking about it. We see on a daily basis what happens to, an individual PSU bank stock if the NPA goes up, it tanks 10%. I think we're looking at total stressed assets right now being around 10% of loans. Different reports say that it could go up. I think it was ICRA report saying it will go up to some 14-15%. What is happening with bad loans?
I think that's the very, very good question that you asked because any bad loans above 5% is virtually wiping out the net worth of a bank. So that's what the broad metric is. 10% which we are talking.
So if you're saying if bad loans become 5% of total loans given out by a bank,
virtually your net worth is done. Whereas you're talking about 10%. I think many of these banks, frankly speaking, are alive for only one reason because they're government banks. Government is financing them. Had they been private sector banks, with all due respect, many of them may be history because that is where the precarious point. I think when all happened in Lehman Brothers in US, I think the bad loans or the NPS that they were talking about, there is barely 2.5-3% because their leverage levels are so high. The bank went bankrupt. In India, still at 10% it can able to sustain because of two reasons. Our leverage levels are not that high. Second is they are government backed. So to that extent they are surviving. But they can't do it this way because if let's say if Modi kind of Prime Minister says, he says let the productivity survive and let the efficiency survive and let one or two banks be punished. I think it will be very, very punishing scenario.
The Sensex at 23,000 doesn't seem to care. The bank Nifty at whatever level it closed on Friday, surging some 5%, doesn't seem to care. What's going on?
I think that is where the liquidity is all about. When the money is in that kind of mode, it just doesn't need fundamentals. I think ground realities and gravitational force only when only when the normalcy restores. Now at this, when the animal spirits are such high levels and steroids are taking over everything else, I think it's just the liquidity, not the fundamentals.
You can't see reality from such a height, I think.
Absolutely, yeah. So.
Well, it's been a pleasure talking to you. Thank you so much for taking out the time and being with us today.
Pleasure.
That's all the time that we have on this week's edition of Policy Watch. Thank you for being with us. We'll be back with you next week.